Today we are discussing FedEx Corporation, ticker FDX. Over the next few minutes, I'll discuss my thoughts on both the business quality and its valuation. Market cap is $53 billion, enterprise value of $68 billion, so you can see about $15 billion in net debt on this business, so quite capital intensive most likely. They're operating in the air, freight, and logistics industry. The FedEx Corporation provides transportation, e-commerce, and business services in the U.S. and internationally. So this is transportation, ground delivery of small packages, freight transportation. They have both a ground segment and I believe there's an air segment, day-to-day delivery services. They also have a services segment, so they provide some of the sales, marketing, and for IT technology and other pieces like that. Basically, they are providing transportation services of packages, U.S. and globally. So the return on invested capital chart can tell us a lot about a business like this. The first thing you can see is you have 20 straight years of profits, always a very positive sign. When you can mark 20 straight years without a single loss, that is a positive sign for the quality of the business. Now, the downside, though, is you can instantly tell something else from this chart. You can clearly see the business cycle. This business is cycling through business cycles. Looks like every 6 years. So every 6 years, you're getting some sort of business cycle, and it looks like these waves in the return on invested capital chart. You're seeing good years here operating in the 13% range for return on invested capital, 14% in 2013, 13% in 2018. So again, these tops are about 5-6 years apart. And then the lows are barely break even in 2009, 4% in 2015, 1% in 2019, and 2020, you can see a 2% return. Now, you can make a lot of money in cyclical industries. The downside here is that these bottoms are pretty low, and so you're getting below even like a 5% range in the bottoms. But the positive is you're not losing money in the bottoms. So you're making money in every year of the business cycle. That's very positive. And in the good years, you are approaching that 15% range. Now, if you can hover around 10% on average, that can still be acceptable, but you can see they're a little bit below where I'd like them to be at 8.4%. However, due to that massive amounts of leverage, this $15 billion in debt, they are approaching the 15% return on equity that I like to see in a business. I like to buy stocks with a 15% return on equity because that allows me to get a 10 to 15% return on my investment if I hold it for a long period of time. That return on equity is kind of like an upper bound of what you can expect as an investor, and so it's nice to have that upper bound there. Now, 8.4% is certainly good enough that when you have that debt leverage, you're getting a really good return on equity. So I'd say this is acceptable, but a little bit more cyclical than my taste. However, the valuation seems very reasonable. PE of 16 is a very reasonable number to see for a business like this. When you get a PE of 15, return on equity of 15, and growth hovering in this close to double-digit range, you start to get a setup for a very attractive potential investment. You can see revenue growing at 8%, EPS growing at 8%. That's tell you there's not a lot of operating leverage happening in the business. Now, you do see assets growing faster than revenue, which is why some of these tops are a little lower today than they were in the past. So there is some increase in the capital intensity of the business, but there's nothing concerning necessarily with those numbers. Overall, this looks like a pretty attractive valuation. I really like buying stocks at about a 15 or less PE. You are having more about a 16, but in the end of the day, 15 and 16 are a rounding error in your overall results. As long as you're able to grow at this 8% rate, when you're having this sort of yield, 6% kind of starting yield, 8% growth, 15% return on equity, you're starting to look like a setup for double-digit returns to you as a shareholder. This is especially important because they're able to do this while continuing to pay out a dividend. Looks like this dividend's in the range of, anywhere from 20% to maybe some more on your overall cost. So they're able to reinvest a lot of that extra money, of course, at these rates of returns that are attractive in order to fund that growth. I like what I see there for sure. The other thing you can just quickly check is you compare the revenue at the beginning of the decade, $44 billion, to $93 billion at the end of the decade. They're more than doubling their revenue over the course of the decade. That's telling you that just validating that this revenue growth is in line with what you'd expect. EPS growth, again, almost doubling. If you use 2021 numbers, they almost tripled, or basically 2.5. So very good numbers we're seeing in the overall growth rate. The hard part as an investor, though, is just that volatility makes it very hard to predict what the future will be for you as a shareholder. Let's think about what these numbers show on the EPS line. 850, 748, 365. So 2 years after making 855, you're making 365. That's a big reduction in your overall earnings. But then you grow for 3 straight years and you go from 365 to 1679. So you 5x your earnings over a 3-year period. That's very attractive. But then the next year it drops by 87%. That's very unpredictable. And unfortunately, the volatility inherent in this business makes it less certain for you as a shareholder that your returns are going to be good. It does justify lower PE ratios, lower price to sale ratios, lower EV to sales when you think about the overall business, because it's hard to project, okay, what am I going to be making 5-10 years in the future when you don't even know what you're going to be making next year? It can be very difficult for you to properly discount that back as a shareholder. For instance, we think about this PE of 16. Well, let's say maybe that's 16 times this 2022 number, $14 a share. You're getting this $209 here. But if you're earning $2 a share, now you have a PE of 100. And so you have to really be careful with these cyclical companies of kind of what earnings numbers are you using? Is it a normalized number? It just requires that second level of analysis. Doesn't mean it's not a good investment. You have some really attractive 10-year median returns. You have some really attractive 10-year CAGRs on growth. It just requires that extra level of work to really be comfortable with the volatility inherent in a cyclical business. If you learned something so far, please hit that like button, but stay tuned because we are about to dive into the income statement. And by the end of the video, I want you to want to be a subscriber. So we're going to add a lot of good value looking at the income statement, cash flow statement, and balance sheet. So cost of goods sold, again, you can see this kind of going up pretty steadily with the revenue. Not much of a concern. One of the things I like to check, though, is your operating expenses compared to gross profit. You can see your gross profit basically doubled over the course of the decade, but your operating expenses went from $5.6 billion to $14 billion. So you more than doubled your operating expenses, and that's some negative operating leverage, which is why your operating profit has only gone from $5 billion to $6 billion, even though your gross profit has gone from $10 billion to $20 billion. That's actually a really bad look for you as a shareholder because it means that the underlying operating expenses are growing faster than your gross profit. So despite good revenue growth, your operating profit is not looking as attractive as you want. Now, what's been redeeming about this is when you have a tax cut like we had this decade, you can redeem some of the actual bottom line because you're paying lower in taxes than you otherwise would. Although some of these tax numbers don't make a lot of sense, you don't see a lot of consistency in what they are year to year. Some years you're showing profits. Again, the Tax Cut and Jobs Act really messed up with some of these numbers and makes it harder to predict. But one of the things we see that is actually really good is your decline in your shares outstanding over time. You started the decade with 317 million shares outstanding. You end with 266 million shares outstanding. So you retired somewhere in the range of 15 to 20% of your shares outstanding over the course of the decade, which is actually quite good. You're getting a 1 to 2% boost in your EPS than you otherwise would simply by the development in the net income line. And I like to see that as a shareholder. Share buybacks are a great use of cash to really help out shareholders over time. Balance sheet. One of the things, again, we want to see, though, is your PP&E. One of the things we said at the very beginning, of course, is this growth in assets is outgrowing your revenue. And you see this when you look at the PP&E. You went from $17 billion in PP&E to $54 billion. So you've tripled your growth in your capital assets. But did you triple your income? No, you didn't triple your income. You 50% higher income. Double if you're generous and you take the 2020 number. Did you triple your revenue? No, you went from 44 to 94 billion. So you just about doubled your revenue, a little bit more, but you had a tripling in your asset intensity, and that's not a good sustainable path in the future. Now, it could be these are, short-term investments. They're going to be able to cut back in investments over time. You're going to have to do the work yourself on that piece, but really understanding why they're making these big jumps. This is their big acquisition here, 2019, 2020. Of course, we're going to check the cash flow statement, see what was going on there, but when you see this big jump over a decade, and yet you don't see a similar jump in your return on your revenue or your operating profit or your net income line, that is a concern that I would have for the future because it's not something you can repeat over and over again. Likewise, you can see this company began the decade with very little debt, $1.25 billion, and you end with almost $20 billion in debt. So you've basically 15x your debt. You didn't 15x your income. You didn't 15x your revenue, but you 15x your debt. Now, you can't repeat that over the course of another decade. So again, that's a big concern. They're using this debt to fund this growth, but the growth hasn't shown up on the bottom line yet. Could it in the future? Absolutely, but you're not seeing those numbers come through yet, so it would be a concern for me as a shareholder today. Now, the cash flow statement, we want to look at depreciation and amortization. You can see a big gap here between net income and cash flow from operations. Now, that can allow you to make these big investments into the business, but it does mean that you're going to see this rising depreciation over time as those assets and expenditures have to be paid off with the depreciation. This means that your net income line is going to be understated compared to your cash flow from operations, but it also means that perhaps your net income is overstated compared to the owner's earnings, because if you just look on any 1 year basis, your depreciation is substantially lower than your PP&E spending. They're not stable or something like that. This number is going up over time. You're outspending that number with PP&E. It means that what could be happening here is that some of what you're claiming in as earnings aren't truly earnings. They're just a missing part of the inflation piece of depreciation and amortization, which will be taken into account in the future, or taken out into account that you need to take on some more debt, maybe less investment in the future, that sort of thing. So something to be aware of when you see those sorts of numbers. I don't really like seeing, of course, debt being taken out each and every year, especially when you compare it to the amount of investment going on, very little being paid out in dividends compared to the amount of investment having to take place. Overall, what we see here for this business is a cyclical business that is fortunately able to avoid losing money in the trough of a cycle. However, this big cycles here are trouble for them in maintaining the high returns on equity that I would like to see. They're hitting that mark. They are also hitting the revenue mark, though, and they're hitting a reasonable valuation mark. All three of these things are good. The big problem for this business is how much they're spending on their assets compared to their growth in revenue, operating profit, and EPS. None of those numbers are keeping up with their asset growth and their debt growth, which means that the future is likely to be worse than the past. And of course, this 10-year CAGR is a backward-looking number, and what we care about is the forward-looking numbers. And so although my backward-looking numbers all look good, FedEx for me would probably be a pass because I think their recent capital allocation over the last 10 years is not replicable in the next 10 years, and so I should expect lower returns. But it's hard for me to predict what those lower returns might be. One, because again, the past is better than the future, and two, because the cyclical nature just makes this business hard to predict. So for that reason, I won't be adding FedEx Corporation to my watch list, but it does seem like a really interesting company with some good underlying economics, especially because they've been able to sustain that for 20 straight years, at least from the data we have here. If you enjoyed this video, please hit that like button. If you think you can really gain some value from this content as we work through every company in the S&P 500, don't forget to hit that subscribe button because I think there's some great educational learning you can do from watching these videos. So I hope you'll join us. And if you want to see what the companies are that made my watch list, the playlist to that is at the top of the video. So if you like this software, quickfs.net, first affiliate link in the description below. Hope you'll check it out. Thank you for listening. And until next time, stop paying fees, start building wealth.